36 hours to meltdown. China export ban hits. 26/6 delivery surge. 36 hours. That's all the time remaining before the global silver market enters uncharted territory. January 1st, 2026, midnight Beijing time. China activates mandatory export licensing for raw silver metal. Not jewelry, not industrial components, raw silver. Every single ounce leaving Chinese borders now requires government approval. Meanwhile, the COMEX Futures Exchange in New York faces something it has never seen before. January delivery demands just hit 125 million ounces, 26 times the normal monthly volume. And COMEX is sitting on just 241 million ounces of registered inventory, the lowest level in 8 years. But here's what nobody is discussing publicly. China supplies 12% of global mined silver, and starting in 36 hours, every ounce needs a permission slip from Beijing. So the question becomes, what happens when the world's largest manufacturing economy decides to keep its strategic metals at the exact moment Western exchanges are scrambling to deliver physical metal they might not actually have? Welcome to Financial Announcement. If this is your first time here, you've arrived at precisely the right moment. We're about to walk through one of the most significant market dislocations developing in real time. Now, if you appreciate this level of economic analysis, the kind your financial advisor probably isn't showing you, just click that subscribe button. Think of it this way. You wouldn't ignore your accountant's advice, would you? Consider this your second opinion. And drop a comment below. Let us know where you're watching from. New York, London, Singapore. We want to know who's paying attention. Let's begin. On December 30th, 2025, financial markets across 3 continents received a notification that most traders initially dismissed as routine regulatory paperwork. The announcement came from Beijing at 14 our local time. Starting January 1st, 2026, at midnight, China would implement mandatory export licensing for all raw silver metal leaving its borders. The financial media called it a regulatory update. They were catastrophically wrong. This was not administration. This was activation of a choke point that had been years in the making. The timing was surgical. While China prepared to close the exit door on silver exports, the COMEX Futures Exchange in New York was staring at something its risk management systems had never encountered in 43 years of precious metals trading. The January 2026 delivery obligations had reached 125 million ounces of physical silver. To understand how abnormal this number is, consider the baseline. A typical month sees approximately 5 million ounces standing for delivery. January 2026 was showing 26 times that volume. Someone, or more accurately, multiple large institutional players had made a decision. Instead of rolling their futures contracts forward into March or May, the way the game has been played for decades, instead of accepting cash settlement and maintaining paper exposure, they were demanding physical metal. Real bars, real delivery. In January, the problem was immediately visible to anyone looking at COMEX inventory data. Registered silver inventory, the metal actually available for delivery against futures contracts, stood at 241 million ounces. That number represented an 8-year low, and it was declining every single trading day. If even 2/3 of those standing for delivery refused to back down, COMEX would be looking at 70% depletion of its available physical inventory in a single month. Now, COMEX operational rules include provisions for cash settlement when physical inventory runs short. That escape hatch exists specifically for situations like this. But the existence of that safety valve misses the entire point of what was happening here. The signal being sent to every market participant watching this develop was unmistakable. Paper silver, the decades-long system of rolling futures contracts forward indefinitely while treating COMEX as a perpetual pricing mechanism rather than a delivery system. The trust was evaporating. When paper markets lose credibility, price discovery migrates to physical markets. That migration was already underway. China's decision to activate export licensing on January 1st was not coincidental scheduling. China had options. They could have implemented this policy in June 2025. They could have waited until February 2026. They deliberately chose the exact date when COMEX faces its largest delivery obligation in modern history. This was strategic timing at the highest level of economic planning. Here's what changes at midnight Beijing time. Every refinery shipment, every industrial export, every single ounce of raw silver metal leaving China now requires explicit government approval. The Chinese government now holds veto power over silver flows that represent 12% of global mine supply. That percentage might sound manageable until the second-order effects are understood. China is not just a producer. China functions as the swing supplier in global silver markets. When COMEX vaults need refilling, when London bullion market dealers need inventory, when industrial manufacturers in Germany need feedstock for semiconductor and solar panel production, a significant portion flows through Chinese refining and export channels. The country processes roughly 100 million ounces annually through its export system. But there is a trap embedded in this situation that makes it particularly dangerous. China became a net importer of silver in 2023. The country now consumes more silver domestically than it produces from its own mines. Yet China continues exporting metal because of long-term contracts, refining relationships, and industrial partnerships that were negotiated and signed years ago when silver was trading at $23 per ounce. Today, silver sits at $29 per ounce. That represents a 26% increase in just 12 months. Those legacy contracts are now executing at prices that no longer reflect current market reality. So the question facing Chinese policymakers is straightforward. Why would they approve export licenses? Why would they allow strategic metal to leave the country at the precise moment it is becoming ammunition in a global supply crisis? The answer shapes everything that follows. They would not. And that makes January 1st the inflection point the markets are not yet prepared to handle. The global silver supply chain operates on a principle most market participants have never questioned. Metals flow to where prices are highest, and producers sell to whoever pays. This assumption has governed commodity markets for over a century. On January 1st, 2026, that assumption becomes obsolete. China controls 12% of global mined silver production. That figure alone does not capture the full picture of Chinese influence over physical metal flows. The country's refining capacity processes far more silver than its domestic mines produce. International miners ship concentrate to Chinese refineries. Recycling operations feed material into Chinese smelting facilities. What emerges are the refined bars and standardized products that feed global industrial supply chains. When that refining capacity comes under export licensing requirements, the disruption extends far beyond 12% of mine supply. The mechanics of export licensing are deliberately misunderstood by Western financial analysts. They frame it as paperwork, as bureaucratic process, as administrative overhead that slows but does not stop metal flows. This interpretation ignores how export licensing functions in practice when managed by a centralized state apparatus. Every application goes through government review. Every shipment requires approval. And approval can be delayed, modified, or denied based on criteria that are never made fully transparent. This creates what economists call a discretionary bottleneck. The Chinese government now decides which silver leaves the country, when it leaves, where it goes, and under what terms. That is not regulation. That is control. What makes this control particularly effective is timing. China is not implementing export restrictions during a period of abundant supply. The country became a net importer of silver in 2023, crossing a threshold that fundamentally altered its position in global markets. Net importer status means China consumes more silver than it mines domestically. Yet the country continues exporting because of contractual obligations signed before this transition occurred. Those contracts were negotiated when silver traded at $23 per ounce. Market conditions have changed. Silver now trades at $29, and the trajectory suggests further appreciation. Chinese industrial consumers, particularly in solar panel manufacturing and electronics production, are competing for the same metal that export contracts obligate refineries to ship overseas. Domestic demand is rising, while domestic supply remains relatively static. From a strategic resource perspective, the incentive structure has inverted. Honoring export contracts made at lower prices, while domestic manufacturers scramble for material at higher prices, creates economic friction that no rational state planner would sustain indefinitely. But China is not acting alone in tightening silver export frameworks. On December 23, 2025, Mexico's economy ministry announced they were reviewing silver export procedures. The language was deliberately vague. The announcement mentioned streamlining, compliance verification, and administrative modernization. What it did not mention was that Mexico produces 23% of global silver supply, more than any other country on Earth. When the world's largest silver producer begins reviewing export procedures during a global supply crisis, that review is not administrative housekeeping. It is preparation for restriction. Then Russia formalized silver as a strategic resource. In November 2025, the designation added export oversight and control mechanisms to regulatory frameworks governing metal shipments. Russia ranks among the top 5 global silver producers. The strategic resource classification gives Moscow the same discretionary authority over exports that Beijing now exercises. 3 countries, 3 of the top 5 global silver producers, implementing or reviewing export restrictions within a 10-week window. The statistical probability of this being coincidental approaches 0. This coordination, whether explicit or implicit, represents a fundamental restructuring of how strategic metals flow through the global economy. For decades, Western financial centers operated under the assumption that commodity markets were neutral, that metals were fungible, that supply would always flow to meet demand at the right price. That assumption is being systematically dismantled. The countries that produce silver are also the countries consuming silver for domestic industrial expansion. China needs silver for solar panel targets that support renewable energy commitments. Mexico is expanding electronics manufacturing. Russia is modernizing military and aerospace systems that require silver's unique conductive properties. These are not countries looking to maximize export revenue anymore. These are countries looking to secure strategic materials for national development priorities. And when national development competes with export contracts signed under different market conditions, the outcome is predictable. Export licensing does not ban silver shipments. It simply ensures every ounce that leaves requires permission. And permission, in this new architecture, is a strategic asset more valuable than the metal itself. The question is no longer whether silver will flow to Western markets. The question is on what terms, under what conditions, and whether those terms are acceptable to countries that no longer need Western currency as desperately as they need the metals themselves. There exists a moment in every financial crisis when the underlying asset and its derivative representation begin to price as two separate instruments. That divergence, when it appears, does not announce itself with alarms or emergency broadcasts. It shows up quietly in premium data, in delivery requests that deviate from historical norms, in arbitrage spreads that should not exist in efficient markets. By the time most participants recognize the fracture, the opportunity to exit has already closed. December 30th, 2025 marked that moment for silver. The Shanghai Gold Exchange, China's primary venue for physical precious metals trading, showed silver trading at a premium of $4.20 per ounce above London spot prices. To anyone unfamiliar with how physical metal markets function, that number means nothing. Context makes it devastating. Normal premiums in healthy, functioning precious metals markets run between 10 and 30 cents per ounce. These small premiums cover transportation costs, insurance, refining specifications, and the minimal profit margins dealers require to facilitate physical delivery. When premiums reach $4.20, the market is no longer functioning normally. It is fracturing in real time. That premium represents Chinese buyers sending an unambiguous message to the global market. They do not care what COMEX futures contracts say silver is worth. They do not care about spot price calculations derived from London over-the-counter trading. They need physical metal, and they will pay whatever premium is necessary to secure it. The price discovery mechanism has migrated entirely away from paper contracts and into the physical delivery system. This is not theoretical. It has happened before in other commodity markets, and the pattern is always the same. In March 2022, nickel markets on the London Metal Exchange experienced a similar fracture. Premiums exploded. Delivery requests overwhelmed available inventory. The exchange faced cascading delivery failures that threatened the entire derivatives structure. The LME responded by halting trading, canceling billions of dollars in executed trades, and fundamentally breaking the contract sanctity that derivatives markets require to function. Trust in that market has never fully recovered. 18 months before nickel collapsed, uranium markets showed the same warning signs. Physical premiums began expanding beyond normal ranges. Spot prices diverged from long-term contract prices. Utilities that had relied on paper market hedging realized they needed physical uranium, not financial exposure. Prices quadrupled over the following 18 months as the paper market lost credibility and physical scarcity drove price discovery. Silver is now displaying every characteristic that preceded those market dislocations. The $4 premium in Shanghai is not an anomaly. It is the canary in the coal mine, and it is singing at maximum volume. But premiums tell only half the story. The other half is revealed in delivery behavior at COMEX. For decades, the futures market operated on an unspoken understanding. Large institutional players would maintain exposure to silver through futures contracts, rolling those positions forward from month to month, treating COMEX as a perpetual pricing mechanism rather than a delivery system. When delivery month approached, contracts would be rolled into future months or closed with cash settlement. Actual physical delivery was rare, reserved for situations where specific commercial users needed metal for industrial purposes. That pattern has broken. January 2026 shows 125 million ounces standing for delivery. That figure is not a record because COMEX has never seen it before. It is a record because it represents a behavioral shift that undermines the entire premise of how paper silver has traded for 40 years. Someone, likely multiple large institutional holders, has decided to stop playing the roll-forward game. They are demanding physical metal. The message embedded in that demand is clear. Paper contracts are no longer trusted to represent actual silver. The only acceptable form of exposure is physical possession. COMEX rules allow the exchange to settle in cash if registered inventory cannot meet delivery demands. That escape mechanism exists specifically for situations like this. Technically, COMEX can avoid a delivery failure by simply paying cash equivalent instead of delivering metal. Problem solved, except it is not solved at all. Cash settlement under duress does not preserve market integrity. It destroys it. When an exchange designed to facilitate physical commodity delivery resorts to cash settlement because it cannot source the metal, every participant in that market receives the same message. These contracts are not backed by real inventory. They are paper instruments that work only as long as nobody actually wants delivery. Once that realization spreads, the migration to physical markets accelerates. Institutional holders who were content with paper exposure begin demanding physical. Industrial users who relied on COMEX pricing for hedging start securing metal through private channels, paying premiums, locking in supply agreements that bypass exchanges entirely. The death spiral becomes self-reinforcing. As more participants demand physical, registered inventory depletes faster. As inventory depletes, premiums widen. As premiums widen, more participants lose confidence in paper pricing. Shanghai's $4 premium is not just a data point, it is proof the fracture has already begun. The paper market and the physical market are now pricing silver as two different assets. And when that divergence reaches a critical threshold, one of those markets will break entirely. The question is no longer whether the fracture will widen. The question is which market survives when it does. Every commodity market operates within a framework of assumptions about how nation-states behave. The prevailing assumption, built over decades of relatively stable trade relationships, is that countries prioritize export revenue and honor contractual obligations even when domestic conditions change. Governments might adjust tariffs, impose quotas, or create bureaucratic friction, but outright commodity weaponization remains rare enough to be considered an outlier rather than a trend. That assumption is about to be tested in ways the market is not prepared to handle. Put yourself in the position of a Chinese economic planner for a moment. Your country supplies 12% of global mined silver. Your refining capacity processes significantly more. You sit at a control point in the global supply chain that cannot be easily replaced or rerouted. Now consider what you are observing in real time. Western exchanges are experiencing delivery demands 26 times above normal levels. Physical premiums in your domestic market have exploded to 14 times the normal range. Inventory levels at COMEX have fallen to 8-year lows and continue declining. Industrial manufacturers in Germany, Japan, and the United States are scrambling to secure feedstock for production lines that cannot function without silver as unique conductive and reflective properties. And you hold the approval authority for every ounce that leaves your borders. The incentive structure could not be clearer. Approving export licenses allows strategic metal to flow out of the country during a period of rising prices and tightening supply. That metal supports foreign manufacturing capacity, strengthens competitor supply chains, and leaves Chinese domestic industrial consumers competing in a market you are actively draining. Denying export licenses, or simply delaying approval through bureaucratic process, keeps that metal in country. It ensures Chinese solar panel manufacturers have access to materials Western competitors cannot easily source. It provides leverage in trade negotiations that have nothing to do with silver, but everything to do with strategic positioning. The rational choice, from a national interest perspective, is obvious. So why would China approve exports? The uncomfortable answer is that they might not, or they might approve selectively, creating a tiered system where certain buyers, certain countries, certain strategic partners receive licenses while others face delays or denials. That selective approval process transforms silver from a globally traded commodity into a bilateral negotiation tool. This approach has precedent. In 2010, China restricted rare earth exports, creating supply shortages that crippled Western electronics and defense manufacturing. The restrictions were framed as environmental regulations, but the strategic impact was unmistakable. Countries dependent on Chinese rare earths suddenly faced a choice: accept Chinese terms for access or invest billions in developing alternative supply chains that would take years to become operational. Silver presents a similar dynamic, but with far broader industrial implications. Rare earths are critical but niche. Silver underpins solar panel production, semiconductor manufacturing, medical devices, electrical infrastructure, and defense systems. The metal is not optional for any advanced industrial economy. It is foundational. Mexico's review of export procedures and Russia's strategic resource designation suggest this is not a China-only strategy. It is a coordinated or parallel recognition among producing nations that strategic metals provide leverage Western financial systems cannot easily counter. Consider the vulnerability embedded in Western industrial supply chains. Germany's automotive sector depends on electronics manufacturing that requires consistent silver supply. Japanese semiconductor fabs operate on thin inventory margins with just-in-time delivery models. American defense contractors building radar systems, missile guidance, and satellite communications rely on silver feedstock that has historically flowed without interruption. Now imagine that flow becomes conditional. Imagine export approvals require technology transfers, trade concessions, or geopolitical alignment on issues completely unrelated to silver markets. The metal becomes a lever for extracting outcomes that have nothing to do with commodity trading. This weaponization does not require explicit bans or dramatic announcements. It simply requires that export licensing creates enough friction, enough delay, enough uncertainty that Western manufacturers cannot rely on Chinese supply. Once that reliability breaks, those manufacturers face impossible choices. They can pay massive premiums to secure metal from alternative sources, destroying profit margins and making their products uncompetitive. They can reduce production, ceding market share to competitors who have secured supply. Or they can relocate manufacturing to countries where export licenses are more easily obtained, which often means relocating to China itself. All three outcomes serve Chinese strategic interests: higher costs for Western manufacturers, reduced Western production capacity, or the migration of manufacturing capabilities into Chinese jurisdiction. But the implications extend beyond industrial supply chains into financial market structure itself. If COMEX cannot fulfill delivery obligations and resorts to cash settlement, confidence in commodity derivatives markets sustains permanent damage. Institutional investors, who believe they held silver exposure through futures contracts, discover they hold paper instruments backed by nothing when physical delivery is actually demanded. That realization does not stay contained within silver markets. If COMEX silver contracts prove unreliable, why would COMEX gold contracts be different? Why would platinum, palladium, or copper derivatives maintain credibility? The contagion risk spreads through every commodity futures market that operates on the same fundamental assumption, that paper contracts are reliable proxies for physical assets. The broader context makes this even more significant. BRICS nations have spent the last 18 months discussing commodity-backed currency mechanisms. Physical gold, silver, and other strategic metals have been explicitly mentioned as potential backing for trade settlement systems that bypass the dollar. Accumulating physical commodities, while Western markets struggle with paper-physical divergence, fits perfectly into that strategic framework. January 1st, 2026 does not just mark a regulatory change in Chinese export policy. It marks the moment when commodity markets transition from financial instruments governed by price signals to strategic assets governed by national interest. The 36-hour window before midnight, Beijing time, represents the last moment when the old assumptions still technically apply. After that, the rules change. And markets built on assumptions that no longer hold tend not to adjust smoothly. They break.